really good at manipulating and suppressing the price, we wouldn't be at 2,700 like we are today. We'd still be at 35. But I think the point of the suppression and manipulation is to put the public off. When you speak to the average person or even, let's say, financial advisors, they say that gold is too risky and it is a commodity. And that's what they want, because they don't want you jumping ship from their fiat currency system. Their game is almost up, because we see China and others, they're buying real gold, and their markets are growing, and they're going to compete with COMEX and the LBMA in London. So that's in a nutshell.
Gold price manipulation allegations are not new, and several high-profile cases have occurred over the years. One of the most significant scandals involves several large banks, including Deutsche Bank, HSBC, and Barclays, accused of rigging the London gold fix between 2004 and 2013. Investigations revealed that these banks colluded to manipulate the gold price during the fixing process, leading to regulatory fines and settlements. Since central banks cannot directly control gold, print gold, or affect the interest rate on gold, investors are now increasingly looking to the asset as a partial substitute for government bonds and fiat currency exposure. A prominent figure in the exchange-traded derivatives market, MarioInnecco, states that major banks find it harder to manipulate gold prices due to increased physical buying from the global south since 2012. From a technical standpoint, he notes that China has established more physical markets, like the Shanghai Gold Exchange, where gold is viewed as a secure asset rather than a speculative one. Together, Russia and China account for 74% of the total gold reserves the BRICS nations hold. However, Mario mentions that Bank of America recently acknowledged gold as a safe haven of last resort, even more reliable than U.S. Treasuries. He predicts that major banks may soon shift their strategies by going long on gold in the futures market, positioning themselves to benefit when gold prices rise significantly. The analyst reaffirmed their target of $3,000 an ounce for gold by the end of next year, which implies an 11.1% upside from Thursday's levels. The Bank of America analysts said, "Indeed, with lingering concerns over U.S. funding needs and their impact on the U.S. Treasury market, the yellow metal may become the ultimate perceived safe haven asset." Now we present the clips of MarioInnecco's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think it's getting harder and harder for the bullion banks and the New York London axis to manipulate the price, because there's been a lot of physical buying from the global south since 2022. I think the other factor is that even the people in charge, like I think it was the World Bank or the IMF, they published a paper early last year saying that, asking the question, sorry, it was the IMF asking the question, so gold is no more a barbarous relic, and that it should be used as reserves. And we've seen also Basel III making gold an asset that you can hold, that banks can hold, in order to calculate their the equity on their tier one assets, to make sure that they are a tier one capital bank. They can use gold, physical gold, they said, not unallocated. And unallocated is the way that they leverage the market. And they do it a lot through London. People don't realize, through the LBMA, because there's no limit to how much you can leverage or hypothecate in London. And I think it was David Jensen, I've had him on my channel, and he said that the LBMA, there's no rules really for the bullion banks. It's like a cowboy, old West kind of environment. But on COMEX, there is a limit. There's a margin. It's usually, I think, about 20 to 1. So you can't leverage any more than that. So yeah, that's how I think it's changing, because people in other parts of the world, like Russia, China, they know about this, and they know that it's the Achilles heel of the dollar system, and they're loading up on physical gold. And the Chinese, they've started exchanges like the Commodities Exchange and the Shanghai Gold Exchange, and those are a lot more physical markets. And other countries as well. I think India, Moscow, even they've started a bullion market, and these people. Yeah, in these countries, gold is not seen as speculative as in the West, as it's been for the last 50 years. So that's why I think it's getting harder and harder. And I think just a day or two ago, even Bank of America now, one of the big Wall Street banks, is saying that gold is the safe haven of last resort. It's better than even treasuries.
Regarding potential shifts in investment, MarioInnecco believes it's the early stages of a gold boom driven by inflation and the potential for central banks to cut rates. Mario suggests that investors may increasingly turn to it as gold outperforms traditional equities like the Nasdaq and S&P. Gold prices extended recent gains to new highs as market uncertainty continued to drive demand for safe haven assets. U.S. stocks also climbed on Friday, with the S&P 500 posting its 47th record close of the year, up 23% in 2024. Yet even as this bull market in equities presses onward, gold seems a key preoccupation for investors hedging against potential risks. Gold's 31% rally in 2024 has completely outclassed the S&P 500's 23% gain. There is a rotation inside the stock market happening as well. Major banks like Goldman Sachs and JP Morgan have challenged major tech stocks. Additionally, Mario underscores that mining companies are benefiting from higher profit margins due to elevated gold prices. He expects that upcoming earnings reports will draw more investors to the sector and remains optimistic about the future of gold and silver markets. Let's get back to the interview.
The break of 2100 earlier this year, that confirmed the next leg up, because up until last year and beginning of this year, we couldn't get back above 2000. I think in February we still tested below 2000, and that was very near the top from 2011 at 1920. So we had to really make a new clear high to confirm the next leg up. And that's why I think we're still in the early days. We still got a few years left. I'm not sure if it's 3, 4, 5, or 6 in the gold bull market. And the main driver, of course, is inflation. And by inflation, I don't mean the CPI, but I mean the fact that central banks are going to have to cut again and probably do QE again. And it means the simple law of supply and demand. Gold is very hard to get out of the ground. Yes, all the gold that's been mined still above ground, but people are not going to part with their gold when they see what's going on. The other driver, I would say, that is probably going to help the gold bull market is the fact that we could see people from other sectors, people who don't watch gold, look at it and say, wow, gold's doing really well. And the NASDAQ, S&P, and Dow, they've done so well. Let's take some profit here and shift our capital towards the precious metals and commodities. So I think that could be a driver. And I think family offices, which are companies that manage money for very wealthy families, they still have a very low kind of percentage holding for gold, silver, or precious metals. That's like 1 or 2% of their assets. So could you imagine people finally realize, wow, gold is doing really well. We need to put a little bit of money into that. And people are going to realize that the mining companies in the last 3 or 4 months, they've done really well because the price of gold has stayed so high. So their profit margins have gone up a lot. And yes, we've got some results coming up, I think on the 23rd, which is when this video is going to be published, from Newmont, and then in November from Barrick. And that could drive a lot more investors into the mining sector as well, in gold and silver. Countries like China and India, and I think that's going to continue. I think what will happen to the silver price, but problem is I don't know when, we could be close, is that once it breaks key levels on the upside, and I'm talking about here 30, 33, maybe, we could see silver move up really quickly. It's not like it's going to keep going up slowly like it has in the last few years, because maybe people are going to say, oh, we'll get to 40 by the end of 2025. No, I think once silver breaks out, it's going to go up really quickly. I don't know where it's going to go, probably test the 50 level, and it could be faster than most people expect. And I'm patient with silver, and I have real silver, but I also have some of the silver miners. And silver is like some people call it gold on steroids. And usually in the precious metals bull market, silver usually leads the way. So I think it's only a matter of time till it catches up. And I think it did the same thing back in the early 2000s. Gold started to go up quite nicely, like in 2004, it broke above 400, which was a key level. And silver only really started moving higher in 05, maybe 06. So I think 2025 could be a good year for silver, if not even the rest of 2024.
Major banks expect gold to extend its record-breaking price rally into 2025 because of a revival in large inflows to ETFs and expectations of additional interest rate cuts from prominent central banks worldwide. Moderating but still significant central bank purchases on the London OTC market could drive about 2/3 of the expected rise of the gold price to $2,900 per ounce in early 2025. Given the potential for further shifts in the gold market, what key factors should investors watch for to maximize their strategies in precious metals over the next year? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.